Hello, welcome all. In this session, I am going to talk on the fundamental analysis, the subject of the investment management. So this is just the introduction of the fundamental analysis. Fundamental analysis involves examining the economic, financial, and the other qualitative and quantitative factors related to a security in order to determine its intrinsic value. It attempts to study everything that can affect the security value, including macroeconomic factors like the overall economic and industry conditions, and the individual specific factors like the financial condition and management of companies. Fundamental analysis, which is also known as a quantitative analysis, involving delving into a company's financial statements such as profit and loss account and balance sheet. Fundamental analysis is the examination of underlying forces that affect the well-being of the economy, industry group, and companies. Fundamental analysis of a business involves analyzing its financial statements and wealth, its management and competitive advantage, and its competitors and markets. When applied to futures and forex, it focuses on the overall stage of the economy, interest rate, production, earning, and management. To conduct a company's stock valuation and predict its probable price evaluation, to make a projection on its business performance, to evaluate its management and its make internal business decision to calculate its risk. Fundamental analysis is a method used to determine the value of a stock. Fundamental analysis is a method used to determine the value of stock by analyzing the financial data that is fundamental of the company. Fundamental analysis is a stock valuation method that uses financial and economic analysis to predict the movement of stock prices. Fundamental analysis typically focuses on key statistics in companies' financial statement to determine if the stock price is correctly valued. So we have a two approach to do fundamental analysis. One is the quantitative, and second one is the qualitative. Quantitative means capable of being measured or expressed in numerical terms, and qualitative related to or based on the quality or character of something, often on opposed to its size or quantity. Quantitative fundamentals are numeric measurable characteristics about a business. It is very easy to see how the biggest source of quantitative data is the financial statement. You can measure revenue, profit, asset, and more with the great precision. Turning the qualitative fundamentals, these are the less tangible factors surrounding a business, things such as the quality of a company broad numbers and the key executives, its brand name, recognition, patents, or property technology. Two approaches to do fundamental analysis. One is a top down, second one is a bottom up approach. Top down means first economic analysis will be done, then industry analysis, and then company analysis will be done. So in this investment management subject, we have to discuss three analysis. One is the fundamental, second industrial, and third is company. So bottom up approach is from the company analysis. The fundamental analysis starts from the company, then industry, then economic. Economic analysis. The economy is a study to determine if overall conditions are good for the stock market. Industry analysis. The company's industry obviously influences the outlook for the company. Company analysis. This is the usually done by studying the company's financial statements. Right. The process of fundamental analysis involves examining the economic, financial, and other qualitative as well as quantitative factors related to security, so as so determine its intrinsic value. Two approaches in fundamental analysis: top-down approach and bottom-up approach. In this approach, analysts investigate both the national and international economic indicators like energy prices, GDP, growth rates, inflation, interest rates. Bottom-up approach. In this method, an analyst starts the search with the specific businesses irrespective of the industry and or region. So this is actually the basic of the analysis, economic analysis, industry and company. Economic macroeconomics is the study of the behavior of the economy as a whole. Macroeconomic is a very complicated and there are many factors that influence it. These factors are analyzed with the various economic indicators that tells us about the overall health of the economy. Consumer wants to know how easy it will be to find work, how much it will cost to buy goods and service in the market. Businesses are microeconomic analysis to determine whether the expanding production will be welcomed by the market. Governments turn to the microeconomic when budgeting, spending, and creating taxes, deciding on the interest rates, and making policy decisions. So, based on this, economic analysis is done. The next is continued with the economics is broadly focuses on national output, that is GDP, gross domestic product, unemployment ratio, inflation rates. On the basis on this, economics analysis is done, and they broadly focus on these three major points. In the first year, in your first year, you will learn about the GDP, unemployment, and inflation. These are the major tools to do fundamental analysis of stock of industry of any company. This is the pure fundamental analysis. EPS, earning per share, price earning ratio, P ratio, dividend payout ratio, dividend yield ratio, price to book ratio, book value, and price to scale. So one by one we will discuss what is the EPS and all things. Actually, you have learned all these things in your first year, but let me explain one more again on this session in this session only. Earning per share. Earning per share is calculated as the company's profit divided by outstanding shares of its common stock. The resulting number serves as an indicator of a company's profitability. It is common for a company to report EPS that is adjusted for extraordinary items and potential share dilution. P earning ratio, price earning ratio. So we have formula to calculate earning per share. Same we have a formula to calculate P ratio as well. Share price is divided by earning per share. So price to earning ratio is the ratio of valuing a company that measure its current share price relative to its earning per share. The price to earning ratio is also sometimes known as the price multiple or earning multiple. P ratio are used by investors and analysts to determine the relative value of the company's shares in an apples to apples comparison. It can also be used to compare companies against its own historical record, to compare aggregate market against one another over time. P may be estimated on a trailing, backward looking or forward looking projected basis. Dividend payout ratio. So we have a formula to calculate dividend pay ratio. Dividends paid divided by net income. So dividend payout ratio can be calculated as the L dividend per share divided by the earning per share, or equivalently the dividends divided by the net income. So we have a two formula. The dividend payout ratio is the ratio of the total amount of dividends payout to the shareholders relative to the net income of the company. It is also the percentage of earning paid to the shareholders via dividends. The amount that is not paid to the shareholders is retained by the company to pay off debt to or to invest in core operation. It is the sometimes simply referred as simply the payout ratio. Next, dividend yield ratio. Dividend ratio, we have a formula, annual dividends per share divided by current share price. Dividend yield measures the quantum of earning by the way of the total dividends that investor makes by investing in that company. It is normally expressed as a percentage. The formula for computing the dividend yield is the dividend yield is equal to dividend cash dividend per share divided by market per share into 100. Price to book ratio, price to book value ratio. Price to book ratio is equal to market price per share divided by book value per share. The price to book ratio is calculated by the dividing a company's market capitalization by its book value of equity. So, of the latest recording period, alternatively, the PB ratio can be calculated by dividing at the latest closing share price of the company by its most recent book value per share. Book value. Book value is equal to the cost of carrying an asset on company's balance sheet. Firms calculate in netting the asset against its accumulated depreciation. As a result, book value can also be thought of as net asset value of a company, calculated as its total asset minus intangible assets, that is patents, goodwill, and the liabilities. For the initial outlay of an investment, book value may be net or gross of expenses such as trading costs, sales taxes, and such service charges, and so on. The formula for calculating book value per share is the total common stockholder equity less the preferred stock divided by the number of common shares of the company. Book value may also known as a net book value, right? And the last is a price to scale. Price to scale means, so we have a linear decision for price scaling. Uh, Price scale is a charting scale used by a trader that is plotted with the real value spaced equivalent from one another on the vertical y-axis. Each unit change is represented by the same vertical distance on the chart, regardless of what price level is set is the when the change occurs. The linear scale can be compared with logarithm scale. The interpretation of a stock chart can vary among different traders depending on the type of the price scale used when viewed the data. So based on this seven formulas, seven ratios, fundamental analysis is done with the numerical quantitative approach. Right? So in the next session we will discuss in detail industry analysis. Thank you. Best wishes.